You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 17th of August 2024, and I'm rejoined today by our special guest, Paul Ahdal. Paul last came on the show back in February 2022. It does feel like less time than that, but it was February 2022 for an interview. For anyone that's not listened to that original interview, I've posted it as a bonus episode as the prior episode to this one. So if you do want to go and listen to it first, that's fine. If you listen to this first and enjoy it and want to go back and listen to a bit more about Paul, you can also go back and listen to it after. So whatever you want to do is fine. Paul, for anyone who hasn't already listened to the previous interview or maybe has forgotten because it was 2.5 years ago, could you just give us a very brief recap of sort of who you are and, your investing journey to date and how you sort of got into investing and where you are today?
Yes, hi Sam. It's good to be back on, and the markets have been particularly turbulent in the last 2.5 years, so it's good to have come through that. In terms of who I am, I'm just a normal guy. I'm now sadly in my early 40s, very early 40s, but still in my early 40s, and I got into investing about just over about 5 years ago. There was no background of investing at all in my family, so I came to investing quite late. I mean, my parents were very young when they had me. I think they were early 20s when they had me. Largely brought up by my mother. We lived in a council house in Middlesbrough. She worked as a cleaner then in a shop. So really life was more about just, paying rent, paying bills, buying food, investing, saving, financial security wasn't really on the agenda. Not a tale of war. I had quite a nice life. I think that the great thing about living in the country we do is we're hugely privileged in that, we've got access to food, shelter, education, healthcare. So no complaints there. But just to really demonstrate that there was no history of investing in my family and in my wider family as well, no history of investing. So I went to university, got a degree in civil engineering, and then what I started doing is after my somewhat reckless student days, I had deliberately had a policy of trying to spend less than I earned so I could do things like pay off my student debt, do driving lessons, buy a car, get on the property ladder, we're buying a house. And I got to the point in my late 30s where I'd fortunate enough to try and build up some savings. So I had a bit of emergency savings buffer. And I was thinking, well, what can I do with this? And at the same time, I was thinking, being reliant on a job, being a wage slave, doesn't necessarily feel the most secure thing in the world and the best way to spend your life. So I was looking at alternatives, and someone I used to play football with who started their own business and has been very successful. Shout out to Scouse Kev, had recommended a book called Rich Dad, Poor Dad, which I read and had a big influence on me. And the two takeaways from that really were that the rich don't work for money, they have their money work for them, which is what investing is. And also effectively he calls it pay yourself first, but what he means really is spend less, invest the rest. So I devised my plan of FU money by 50. So what I did is thought, how much money do I need to be able to pay for all my essentials in life using a 4% safe withdrawal rate? What does that look like as a lump sum? And then I've been targeting using my ISA to get to that amount so that, I know I don't want to do a job. If I want to work less, couldn't probably retire off it and live comfortably, but I've got something there to give me that security. And I've been essentially targeting using my ISA to get to that amount, targeting a 10% return a year. Very much bitten by the investment bug and have all the usual influences that I think most people in investing do. And that's what I'm continuing to work towards, essentially.
Can we talk a bit more about that target of 10% a year? Because in terms of your track record, you've obviously got 5 or 6 years under your belt now doing this. I think it's 6 years, and you are on track to hit it 5 out of 6 years, including the current year to date. So how do you feel about the level of performance? Because I think you must be fairly comfortably ahead of your target by now, actually.
I have mixed feelings on it, and doing something like this, I was aware of my performance, but it's made me really focus on it and brought it home more. So if you'd asked me this at the start of my journey, I'd have been delighted. But when I was looking at this question, my initial reaction was I felt a little disappointed in my performance. And looking at that a bit more, I think one, maybe, I've achieved my aims, so that's great. But on the other side of things, I've looked at it and thought, well, I'm a bit ahead of the FTSE All Share, and that's probably my most relevant benchmark. But if I compare it with, say, SWDA, which is an iShares World Tracker, I've lagged that. And I thought, well, really, I want to be doing better than a simple world tracker. I mean, I have got tracker exposure in my SIP. My SIP are all trackers, but to make it worthwhile, I want to be better than that. That said, investing, it is the financial return, but it is a hobby. I enjoy analysing companies. I enjoy the art of investing, and I do think there are issues with world trackers in the amount of exposure they've got to the US, which is very highly valued, and the amount of exposure they've got to a small number of highly valued companies. But that said, when I say that, I'm telling myself once a hear, and I sound like every underperforming fund manager out there with that type of rhetoric. So, if readers want to send me 1% of their assets under management for me to make excuses about underperforming the benchmark, I can be just like every other underperforming fund manager out there, including some high profile ones. So I think, being reflective and being perhaps a bit fairer, I've been happy with my performance. I do think I can improve it. And I think certainly in later years, as I've got more experience, I've taken steps to improve it. That said, I think one of the key lessons I've learned is that it's very hard to go against the market direction. So I think since we last spoke, we've had some very difficult times where markets were dropping, and you might be able to lose less than the market. But I think when the market's very negative, it's very difficult to get a positive return. And on the same kind of side of that coin, you shouldn't get carried away with a positive return when markets are positive, because everything tends to get lifted. It's a case of the rising tide lifts all boats. So I think in summary, I'd say I'm relatively content with my performance, but I do want to improve it. And I think being able to be better than that world tracker is something that I'm aiming for. But again, it's I suppose the other excuse I'll give myself get out clause is that those kind of comparisons, you've got to make them over a long time period, and certainly probably longer than the time I've been in the market for.
I do feel like you're being a bit harsh on yourself there, because I think over the 6 years, certainly in terms of the target that you'd set when you came on 2.5 years ago, you've smashed that. But then if you look at the makeup of your portfolio, I think it's fine to compare yourself to a world tracker. But if you're serious, unless you're seriously willing to increase your US exposure, it is a bit unfair, because you're basically comparing yourself to, I know it's a world tracker, but it's 50% US. And unless your portfolio reflects that, it's just an unfair benchmark. It's kind of like picking, an index of French companies and using that as your tracker. If you don't have any French stocks in your portfolio, it's not really, or you could use Bitcoin as a tracker, for example. But I think if your portfolio is predominantly UK shares, I think the most appropriate benchmark is the FTSE All Share. And there might be other world trackers or various countries or continents that will outperform. But unless you're willing to have your portfolio mirror that a bit more in terms of the way it's sort of built up, I just think it's an unfair comparison to use.
I think those are. I'm happy with that as a viewpoint, Sam. And I think instinctively I'd agree with it. And if it was someone else, I'd say much the same thing. I think I'd just like to. I suppose it's more a case of having that stretch target. And I think generally the challenge, particularly when you look at fire forums, the challenge I think active investors often get is, well, how have you done compared to a world tracker? So that's where that thinking comes from. But I agree. And, I look at the UK and it is unloved, and it's still unloved, although things have improved a lot. And I think there may well come a time when the FTSE All Share outperforms a world tracker. So yes, I think an appropriate benchmarks is probably correct. But I was in a way, I was arguing myself about, is there another cheap investment product out there that is a viable alternative? But I think again, and touching on some of what you've said there, would I ever put 100% of my portfolio in a world tracker with that much exposure to the US? And the answer to that is no. And I don't do that with my passive allocations in my SIP. So again, it's if you'd never do that, it's probably, you're right in that it's probably not the fair comparison.
I think as well, there's absolutely nothing wrong with sort of striving for better performance. And if you've sort of hit 10% for the last 6 years, there's nothing wrong with targeting maybe like, I don't know, 12% or something, as long as that target doesn't then impact your behavior so that you're taking more risks to try and hit the higher targets. But if you have a 10-year period where, say, over the next 10 years, actually the US stocks fall off a cliff, the world tracker does very poorly as a result, and the FTSE's bombing away, would you then argue that the world tracker was still the most appropriate one to use? And I think at that point it'd be obvious. Well, it would be a no-brainer. It's like, well, no, it's the FTSE. It doesn't matter if the FTSE's doing 10% a year and world tracker's only doing 5. The FTSE should be the benchmark because that's what reflects my portfolio and sort of where I'm located geographically. So I think just because one's been outperforming the other doesn't mean the benchmark should be shifted, if that makes sense.
No, I agree. And I continue to measure myself I just track my portfolio on SharePad. I continue to measure myself against the all share. I just threw in that world tracker just out of interest. So I agree. You'd always be kind of chasing your measurements against whatever the best performing kind of benchmark measurement would be if you were doing that. So I think that's a fair point. And I agree.
You mentioned obviously the FU Money by 50 is still going, which you talked about last time you were on. Have there been any sort of major philosophy changes since you first came on the show in terms of how you're doing your investing or how you think about it? Or is it pretty much just sort of carrying on as you were?
It's pretty much just carrying on as I was. I think I'll go a little bit deeper now, and I've supplemented some metrics. So I'll briefly summarize it for people who can't recall it from my first appearance. But essentially, I've got around 30 metrics set up in SharePads that look at a mixture of business quality, so things like return on capital invested, operating margins, and so on, and management quality, so looking at how debt's managed, share count is the dilution, revenue profit per employee, and things like that. I'll give each metric a red, amber, or green, depending on how often over the past 10 years they've hit that metric. And if I've got kind of 70% green or greater, I'll then move on to value it. I think I have changed my valuation strategy slightly in the last time I was on, I was reliant on a discounted cash flow. I think what I've learned more is that I was aware that it was impossible to be precise with valuation. It is only ever a vague estimate. I've just added some additional valuation metrics to try and get a bigger picture, more of a flavour of what the valuation is. So I'm looking at things like earnings power value, which essentially is how much of the current share price is reflected in current revenue and profits, how much is on future growth, things like free cash flow yield, which Terry Smith is a big fan of, and again, I think gives a good approximation. And I like a reverse discounted cash flow, which is instead of trying to project what a company's worth, looking at the current valuation of the company based on current cash flows and say what level of growth does the share price imply based on the current valuation. And if it's implying a huge amount of growth for a company which hasn't demonstrated that level of growth, then you know that there's something potentially amiss there in the valuation. So I'm doing that. I'd say I'm looking more at the annual report and particularly accounting notes. And I've started having a look at broker notes as well. To a certain extent, I take broker notes with a pinch of salt because brokers tend to be flaky and adjust the expectations regularly. But although they can't predict the future, I'm just looking at it to see if there's anything contained within there that might give me a bit of a either a positive or a negative point. And then as I'm doing all that, I'm listing bull and bear points. I'll look at those with the valuation and then make a decision on if to invest. When I do invest, I do tend to scale in. I won't take a full position because it's very hard to get the timing right. And I like to leave room to either average down or average up or cut my losses. I think I've made a real mistake. And in terms of my initial investment, I'm happy to let my winners run and grow as much as I need to, but I'll limit my position size to a maximum of 5% and sometimes less than that for small caps. Again, what I found particularly in the markets over the past 2 years is that's been invaluable, because I've had some shares that have went down a lot and then come back quite a lot, and that position sizing really helps to deal with that volatility.
When you talk about the maximum 5% position size, is that on a cost basis or a valuation basis?
Cost basis. So that's my money that I'm putting into that investment as a percentage of my portfolio, not the total value of my portfolio, but the total cash investment I've made into my portfolio.
What proportion of the portfolio is held in, because you've got a section for funds, trusts, and T-bills. So how is that allocated?
So roughly 25% is in trust funds and T-bills. The bulk of that, so just over 20%, is in trusts. That's really to give me exposure to something that I don't feel as confident as investing in individual shares, or where it's a area of the market I can't access individually. So, for example, one example there, HD Capital Trust gives private equity exposure, and that's been a very good performing trust. Fidelity China Special Situations, that gives me access to China. I wouldn't feel as comfortable investing in individual Chinese companies, and there can do a small amount in listed Chinese companies. The T-bills, I've currently got 3% in short dated UK T-bills. That's somewhere I've tried to get into the discipline of having some cash in my ISA to be able to take advantage of opportunities rather than an opportunity come along, I'm fully invested and I can't take advantage of it. So those T-bills are just there to get a little bit of a higher interest rate. So that cash is there and relatively easily accessible in order to do that. I've just got one fund, which is 1%, which is the Buffettology fund. That's one that I'm going to look to sell just because it's, I like the idea behind it in that it's creating a British style Buffett investing approach, but largely that aligns with my own investing approach. And do I want to be paying someone more than 1% fees for the privilege of doing that in an open-ended fund, which makes it very difficult to perform, particularly when in a market downturn, when they'll have to be forced sellers to meet redemptions at the wrong time. That doesn't, that open-ended fund structure doesn't really sit well with a Buffett approach.
Yeah, I agree with that. Can you talk about why you like Dunelm? Because it's currently up 70%. And it's a funny one, Dunelm, because we covered it a few times on the show, and we've always liked it, and we felt it's definitely one of the higher quality retailers. But it's up 70%, and it's, in terms of the PE, it must be at sort of, I don't know, like 16 now, when maybe you could have got it at 10. So do you still like it at 16? And if so, why?
Dunelm, I still like it at 16. I will caveat in that I like holding it at 16. I'm not adding to it at these levels. So effectively, in terms of why I like Dunelm, I think it's a really good quality UK retailer. It shows in some of the quality measures. So the return on capital employed is consistently above 15%. The gross margin is around about 50%, and the cash conversion is around 100%. So it's generating a lot of profits into cash. One of the founders owns a significant amount of shares and is life president. So he's got skin on the game and will be holding his management team to account. And they're also growing in all regions and in all age groups. I think the last set of results mentioned that was particularly strong in London and the 16 to 24 age bracket. What I'm thinking is that given the current drive to build more homes and increase the housing supply, generally when somebody buys a new home, they don't want to take old furniture into it. They want to buy new furniture. And Dunelm really appeals across all the age demographics and all the budgets, and they demonstrate that well in their literature. They're also continuing to grow their digital sales, and they've only got a 7% market share in homeware and furniture. So there's room to grow, although I would caveat in that I think that is a very competitive sector, and I don't think you're certainly going to see one player with something like 50% of the market share. So I would caveat with that. And I think for me, whenever I'm there, it strikes me that Dunelm have successfully replicated the Next model. The stores feel quite similar, and they've got that hybrid of in-store purchasing aligned with a click and collect from the store. And also they've got the coffee shops, Pausa coffee shops, which create a bit more of a destination, and they actually own that, whereas I think Next have a type of Costa. So I'm not intending to sell unless it gets to a silly valuation. If it gets to the kind of valuations we see on some of the US retailers, then I'll have a think. But I always look at dividend yield based on my purchase price, because I think that is the actual yield that I'm getting. And last year, my dividend yield for me on that metric was 9%. So I really don't need much share price growth or dividend growth to achieve my 10% target off that holding. So I think the business is continuing to execute. If it continues to execute and the price of the shares doesn't get too highly valued where it's bubble territory, then I'm happy to hold and sit back and collect the dividend.
Fair enough. I mean, we do obviously like it on the show. We've covered it a few times. I think the only criticism we ever have of it is that it's just not as good as Next. And then when you look at the valuations, they're always fairly similar. I'll just check the market cap actually, because I know Next I think it's about 5 billion. No, it looks like Dunelm's 2.5. But yeah, we do like it. Did you ever look at Next, or did that ever come across your sort of filters?
I did. I found myself looking at my list of my spreadsheet tabs of things I've analysed, and Next is definitely one of those that got away. The
We
reason
both
I've
feel the same.
liked, yeah, definitely. It's its performance, particularly for what it is. I just didn't think it could perform like it has for the type of business it is, which goes to show what I know. I think the thing that steered me more towards Dunelm than Next is Next does homeware, but it's predominantly, I think, fair to say, fashion and clothing. And I just think that the world of fashion and clothing is a bit more fickle, and tastes change quicker than it does homeware. I know homeware is essentially fashion, but I don't think that fashion moves as quickly. And I also think, whereas it's easy to order a load of clothing online, collect it and send it back, and the cost that goes with that. Typically if someone's buying some furniture or, some other soft furnishings or artwork, then I think they're more likely to want to see it and think about how it'll go in their home. So I think Dunelm might have less of that churn with the ordering and returning things than what a business with a significant clothing segment would do.
Fair enough. I mean, Next one where we've covered that for years, and we've both always really liked it, and I think it's been on the watch list for both of us, and neither of us ever pulled the trigger. But that's life. I think we do have it in the fantasy portfolio, but unfortunately we don't get anything from that. So, can you talk about YouGov? So I saw that one on your list, and I actually hadn't realised it was listed. So why do you like it? And also, what is the actual business model? Because I think what we're known for is doing the polls, but how do they actually sort of monetize that?
YouGov is very famous for doing its political polling. I think it's famous for being one of the more accurate posters out there. Really, I view that political polling almost as an advert for YouGov's panel and data services. So its business is split into three segments, one being data products, where effectively a customer gets all of YouGov's poll data in a segment that they're interested in onto like a dashboard, and that's a subscription basis, and it can be very high margin potentially because the same products can be sold to many clients. So I think Fox Sports used it in the 2022 World Cup to see the effectiveness of partner brands advertising during the World Cup and how that played out with the audience. They've also got a data services sector, and this is when a client wants almost like a one-off snapshot of something. So it's kind of a fast turnaround survey. So the client will go, we want to know how your poll feels about this, and YouGov will use their panels to get a feel for how customers would react to that and feed that back to the clients. And then they've got custom research, which is much more kind of traditional consultancy, carrying out real deep research into a particular ask from a client. But underpinning all that, and one of the reasons I like it, is that YouGov's got one of the largest and most established research networks in the world. They've got 26 panel members. They've been set up. Sorry, 26, not 26, 26 million. 26 wouldn't be a very big sample size. 26 million. And they use those panels. They can get the data quickly, and that can be passed on to their customers quickly. And my view was that effectively data is becoming ever more valuable in the modern world. Database decision making, the importance of that is only increasing. Those panels are well established, and I think it's hard for competitors to create something with that track record. So my theory there was that offers them something of a moat. That's been reflected in its performance. So it's had a good growth record. I think the CAGR of their revenue has been over 15%, and EPS has had a CAGR of over 25% over the past 5 to 10 years. Operating margins have increased to the low double digits, which is encouraging. And one of the founders, Stephen Shakespeare, still holds a significant amount of shares, and he's now, I think, at chair, so he's still actively involved in its business. And nearly half its revenue is from the US. So although this is a British listed business, it's actually doing a lot of work in the US. And I've always thought that if this type of business was listed in the US, the share price would be a lot higher. It's one of those where, despite that, I bought a valuation I believe to be fair after it dropped pretty significantly from its high of just over £15. They've since had profit warnings on the back of slow sales in that data products sector, which is the platform type of products that I talked about, and the shares are somewhere now below my entry price. The most recent presentation by their management team was interesting in that the chief executive claimed that one of the reasons for that is that they've got competitors who are effectively offering much cheaper products, but he was very confidently saying that those products are really inferior, and the customers, when they realise that, will come back to YouGov. Now, that's one of the reasons why I haven't cut my losses and sold yet, partly because the drop down on the day of the profit warning, it was just too late to get out. But the other thing is that I think if those customers do return, what that tells me is that YouGov product is as good as what they claim it is. And that, I think, is a real bull point for owning shares here. However, if those customers don't come back, then what it says is that actually what YouGov are doing isn't that special, and effectively their competitive advantage is just going to be eroded away. The other thing which I think is interesting is that YouGov, they recently did a large acquisition, which the market didn't like, of GfK's consumer panel business, CPS. Now that's been established for over 50 years and gives them a foothold in 16 European countries, and it's based on shopping data. And the only reason they were able to buy that business is that GfK and Nielsen were merging. That merger was subject to a lot of antitrust investigation by the EU, and the EU was only prepared to let that merger happen if GfK disposed of that consumer panel business to YouGov. So they've potentially picked up a big, well-established business that neither of the merging companies wanted to sell, but had to. And I think that's quite interesting because the size of that business and the size of that acquisition, if it is a good business, then that could be quite the coup for YouGov and quite accretive to their earnings and revenues. So that's why I like it. That's some of my concerns, and that's why I haven't sold, but happy if you've got any thoughts on any of that, Sam, or whether it's something you'd be interested in.
Yeah, it is actually. So it actually sounds not dissimilar to Trustpilot, who we have covered on the show. In that Trustpilot's another one where it's you know what the business does, and then you think, well, actually, how do they actually make any money? And it's obviously they've got all this customer data for businesses, and they will then sell that data to them. Trustpilot is unfortunately extortionately expensive. In fairness, if you believe obviously that it's going to hit the growth figures that they're sort of priced for, it might be okay. But for us, we look at it and it's one where it's like, well, if that dropped by 2/3, we'd be seriously interested in it. I've never looked at YouGov before. Actually, I didn't realize they were listed on the AIM. My initial reaction is I actually think it sounds really interesting. And I think even with the price drop, so just looking at this trading update now from, is it the 6th of August one that you're
Yes.
talking? Yeah, so they're still targeting revenue of 327 to 330 million, which is still significantly above the revenue for the prior year. So what was it the year before? So in the year to July 23, it was 258 million. So that's still a very, very respectable rate of growth. I'm just going off what it says on Hargreaves, so I don't know if this is going to be coming down or not, but it's saying it's currently trading on at least a historic PE of 14. So to me, it kind of looks like the drop off seems a bit higher than you'd expect, if that makes sense. Because if it hits the figures they're saying in the profit warning, you'd still think it's I guess it's that I think the operating profit maybe is going to be the same on that higher revenue. The operating profit is basically going to be flat on that extra revenue. Do you know why that is? Is that just because of marketing spend or something like that? Or
I think largely they've had, so I think again with the economic climate, I think they've lost some customers. I think there's some costs associated with integrating an acquisition of that size into the business as well. But similar to you, I've looked at the forecast for 2025 and 2026, and the profit then increases significantly now. Whether they can achieve that or not, that's always the $1 million question, isn't it?
but the thing is at 14 times earnings for a business that you would think is in an industry where it's going to have a lot of tailwinds. Obviously, if those customers that have lost do come back, that's just a bonus. But if not, they're still growing at a very good rate anyway. And assuming they're still going to be growing, albeit maybe at a slower rate than what was expected. And then, so if they're growing profits 27%, and that's in a bad year, and operating profits staying the same because of those integration costs, and that sounds quite encouraging because those integration costs at some point will drop out. And if it's trading at 14 times earnings on what basically the market considers to be a very poor year, firstly, I think my reaction would be, well, revenue is still going to grow at a decent rate because it's grown 27% this year. So it might slow down, but it doesn't seem like they're moving to negative growth or anything, or revenue decreasing. And then on top of that, the integration costs when they disappear will just feed straight through. So I don't know how much the integration cost will be, but it could be it's actually already on a PE of 10 if it doesn't grow at all. And given the industry it's in, I think it looks potentially very attractive. So yeah, I think I've made a note to try and remember to cover it actually in the next week or two on the show. But my initial reaction is I think I quite like businesses like that where it's so cheaply priced that it's kind of like, well, even if it stays the same price, you can probably, even if it doesn't really grow, you can probably still get a fairly decent return from it.
Yeah, I'd agree. And I think the valuation is, like you say, for a business like this is relatively unchallenging. It's, comparing back to Dunelm, you wouldn't expect this type of business to be trading on a lower multiple than Dunelm.
If I compare it to Trustpilot, which is the one I mentioned earlier, I know when these businesses are sort of just turning on the profits and they're reinvesting everything into the sales and the marketing, the PE is not actually that useful a metric. But comparatively, it is quite useful because Trustpilot's PE is at 149, which values it at, obviously 10 times more than YouGov on a PE basis.
Yeah, and you've got to think, one is Trustpilot a better business than YouGov, and is it that much better? I'd say I've not looked at Trustpilot in a lot of detail other than what I've heard on the show, but I don't get the impression that it's better, and certainly that much better than YouGov. I think one of the problems with YouGov, it had grown so well for so long that obviously attracts a different type of investor. And once you get a blip in that momentum trend, you lose a lot of that low conviction investor base, or investor bases that are perhaps following trend, following strategies. But what I'm hoping for is that is presents a classic opportunity to buy a business like this at a reasonable valuation.
I think it's difficult with stuff like this because obviously the thing is you're getting it so cheap, and sometimes it's cheap for a reason, but I think you've got to take a bit of a punt on it in that if what's going on now is genuinely just a wobble and those customers come back and the integration costs drop out and stuff, you probably got yourself a bargain. Whereas if it's the start of a trend and actually lots more customers are going to start and the growth's going to fall off a cliff and actually they're going to start losing revenue, obviously at that point it was actually the first warning sign of it. But I think, when it's at 14 times earnings, you can afford to take that risk really. Whereas if it's at 50 times earnings, it's much, much more of a gamble because a lot more has to go your way to justify the price you've paid for it. So yeah, my initial reaction is, having never looked at it prior to this discussion, is that I do want to take another look at it on the show at some point.
I know that 3 of the directors, including the chair and the chief exec, made purchases in June and July of, just over 100k, a little bit more in some cases. An okay thing for people with that amount of money. It's not significant, and sometimes directors do this just to try and shore up the share price. But would you really throw a 6-figure sum at a business if you thought that actually the story had changed and it was no longer going to be a growth story and was going to decline? I find it hard to believe that anyone would throw
I
away
can't
that
remember
amount
who
of
said
money.
it. Yeah, I can't remember who said it, but someone said that, like, with CEOs and stuff and management teams, you've got to be careful when you look at their own activity. Because, for example, with the sales, people can sell for all kinds of reasons. So someone could sell stock in a business they work in, and the market might react to that. And they might have sold it because they've got a relative that needs looking after or something like that, and they're putting money to one side. There's all kinds of personal reasons. Whereas when it comes to buying, people typically only buy for one reason. So it's probably something you can take much more notices of them when they are selling. Can you talk about System One? Because that's one we did look at recently. I think after you brought it to our attention, it's up 165%, and you've marked it on your spreadsheet as played out. So does that just basically mean the thesis has played out and you intend to sell that at some point?
I think for me, I don't think the thesis is I think the first part of the thesis has initially played out. So some years ago, System One had done an acquisition of Brain Juicer, which was looking at, predictive assessment of advertising. I know you talked about it on the show, so I won't cover it too much here. And they had a transition from a traditional marketing business more to focusing on that. That transition was quite painful because the revenues and profits dropped off from that traditional service, and they hadn't quite come through on the more digital side offering. And I was actually at one point, I think I was around about 50% down as that was happening. But I had faith in the management team. Well, I think not necessarily faith, but I think with any business, things don't happen overnight. If you're going to invest, particularly in a small cap that's doing something different, you have to give it time to play out. It has been incredibly tempting for me to sell or sell some of it. I've really found it hard to resist selling some of it when it's grown that much, but I'm going back to my investment philosophy here. And, I think to get the best performance, you do have to hold for a long term. I think Charlie Munger said the money's made in the sitting and waiting. And my strategy with my small caps is to let them run, because I think that's where you get the growth. I've got the likes of Aviva and Dunelm in my portfolio to provide the stability and high yield. And if you look at what the forecasting there can do, then there's still a lot of growth ahead. It's capital light, so it could benefit a lot from operational gearing, and they've recently announced that they're restoring the dividend, which gives you a little bit of sweetener whilst you're waiting for that to happen. The founder still holds over 20%, and he's advancing in years, and he's not selling, so that sounds positive. And there was a former chair and former CEO who had a bit of a spat with the current management team and tried to oust them with some financial backers, and he still got around 6%. So the fact he hasn't sold out yet, I think he'd said he'd sell out if it got to where it was around about the £4 mark, and he hasn't sold his holding yet. So that suggests that he still seen something in it, even though he was, not aligned with the current management team. And I was looking at there's a paper called The Makings of a Multi-Bagger, which was done by a firm called Altafox Capital. And it has a number of case studies with some key findings. It's a really easy read. There's a lot of case studies in there, but it's a great resource as an investor. And I think if readers can Google that, I'm sure they can find it. Readers, listeners even, they can find it, and it's well worth a look. But it looked essentially at 100 highest performing stocks over a 5-year period with a total shareholder return of greater than 350%. And I'm not saying this will happen with System 1 because I can't predict that, but it shares some of those characteristics in that it's well below £2 billion market cap. I think of these multi-baggers, it says that just over a quarter of them had a transformative new product. I'd say that System 1 broadly fits that. And it also said that many had healthy multiples that grew further. So it's very tempting to take either bank the gains or take some off the table. But sometimes I think the worst mistake that someone can make in investing is to sell, and almost the unrealized losses from selling something too early could be a lot higher than the actual losses that you'd make if you cut something that fell a lot. So I'm trying to manage my biases and behavior to hold on there, although the temptation to cut some has been very high. I think, again, it's something I'll keep an eye on, and if they continue to execute, then I'll continue to hold. If I see signs that execution is not happening or they're not performing as well as what they said they would, then trimming some or all is definitely an option. But I do find it incredibly difficult knowing when to sell. I think it's the hardest thing in investing for me.
Yeah, I think when we looked at it, I appreciate that it's still, relatively speaking, pretty small and that it's still got a market cap of under 100 million. But I think when we covered it, it was obviously it's sort of tripled in the past 12 months. And you just look at that and you kind of think, well, how often does a business triple in 12 months? And the time to get in is after it's done that. And it could go on and sort of do really well from here. But I think when you've not to start a position when it's done that, you've got to be really, really confident. And I think from us initially, it was trading at 45 PE, and it was like, well, there's probably better places for our money at this point. If we'd found it 12 months ago and it was at a PE of 15, we might have felt a bit different. Although it might have not been a PE of 15 at that point, because I think the profit seems to have shot up as well in the last 12 months. But yeah, it looked like an interesting business, but for us, it was just the valuation really was why we didn't want to look any further. I do think as well, I would always be cautious if you've got like an elderly shareholder that hasn't sold. So I know it can seem quite encouraging, but my initial reaction is because it's AIM listed, if he's held those shares for more than 2 years and if it's a trading company, he won't have any inheritance tax on it if he holds it at death. So I do wonder if that plays a part in his decision to hold, in that it's basically free of inheritance tax as long as he keeps it.
Yeah, I think I've probably done him a disservice in calling him an elderly. I think he's like, I've referred to him as elderly as in probably reaching retirement sort of age. He's not in his 80s or 90s.
Okay.
More to the end of his career. And I don't know, I suppose some people go on for a long time, but elderly in that sense. I mean, this one's never had a traditional cheap valuation because, like you say, it looked expensive previously because the profits weren't there to the extent they are now. But looking at some of the growth forecasts on SharePad, they're expecting turnover to grow by just over 20% in 2025, and then further growth of just over 15% in 2026, and then post-tax profit to grow by more than that, over 40% in both of those years. So if they hit that, then that multiple could be grown into quite comfortably. But that's always the challenge, isn't it? Is the current profit growth the low-hanging fruit, and the easy gains are those aspirations going to be a lot more difficult. Like I say, for me, I probably wouldn't buy on this valuation. The only reason I've not sold it is because I know a bit about the company, having held it for so long, and knowing the potential for growth. And also with something with this smaller market cap and the space it operates in, is it beyond the realms of plausibility that one of the bigger tech companies comes along and just acquires it?
When you look at the share price in 2017, it had an absolutely massive run up. It looks like it got to sort of almost £10 a share, or £9 a share, £10 a share, and then it sort of ran all the way down to about £2 a share. Do you have any reason what that was? Or was it just sort of hype around the product?
I've no idea. I suspect it would be that, and it still was generating cash from the more traditional part of the business. So that was before I really looked at it. There's a guy called Maynard Payton who I think has held this for a long time, and his write-ups are excellent. So again, I'd recommend anyone who wants to learn more about System 1 and the history of its performance, if you go to Maynard's page, there's some excellent write-ups on there, but no, that was before my time, so I'd never really looked at that by the time I picked it up. It was focusing on this transition to the new product.
Do you give us a recap on mine, Jim? Because I think that was one you discussed the last time you came on the show. I don't want to beat you up too much, but it's down 77%. So what went wrong, and what do you think you've learned from it, really?
That was a very gentle beating up, Sam. I beat myself up a lot more when I log onto my SharePad and broker account and see that number staring at me. In terms of a quick recap for what Mind Gym is for, I discussed it in detail on the previous podcast, but essentially it's behavioral-based corporate training and coaching. So it's got a focus on behavioral science, particularly in management and leadership development and customer service type skills. It's founder-led. There's two founders, and between them, they own over half the shares. One's a qualified psychologist and writes a number of papers that inform the product. When I bought it, they were working with, and still do, some big blue chip clients. So you're looking at likes of Coca-Cola, KPMG, ING. They had a high percentage of recurring revenue and generating cash, and they had grown pretty well. So in 2016, they'd had revenues of 25 million and a profit of just over 1.5 million. And when I picked them up in 2020-ish, they'd increased revenues to 48 million and profits to just under 4. And it's all been downhill since then, been a bit of a car crash. So when I've reflected, I think there's two main things that I can point to with this one. The first one is that it's much more of a cyclical product than I think I'd appreciated and the management had appreciated. So when the business climate started to change in the wake of high inflation, all that's happened is those businesses reduced or deferred spending on Mind Gym products, particularly the diversity, equality and inclusion products, which is one of their specialities. So it's a classic case of operational gearing going into reverse. They had that relatively fixed cost base, but revenues dropped, which meant that had an outsized impact on the bottom line. I think the other factor, and it's great looking at founder-led businesses and people talk about how good they are. And broadly speaking, I agree with that, but there's always another side to that coin, and I think that's at play here. I think it's ill discipline and a lack of self-awareness from the CEO on the limits of his capability. So in 2020, they were doing kind of in-person course delivery. I've been on some of them, they were very good. The move to remote delivery, which didn't work quite as well, but the CEO doubled down on that. So he embarked on a very costly digital transformation, which has used up a lot of the cash. And to be frank, I fail to see what benefit that transformation has had on the business. It doesn't appear to have had any. It just appears to have been the opposite, in that it's damaged a lot of shareholder value. And I think you can see that I think they capitalized some of those costs, and you're looking now at significant, multi-million pound intangible write-downs, which I think shows that actually a lot of that transformation and digital spend just hasn't added any value to the business. Why do I still hold? I think in part when I saw that digital spend increasing and not any benefit coming through, in hindsight, I should have sold then. I didn't, and this is now a very small part of my portfolio for all the wrong reasons, so that makes it somewhat easier to deal with. I think the other thing is that I think if nothing had changed, I'd just be taking a small amount of money I've got invested in this back, but there has been some fairly significant management changes. The chief exec has been moved to chair, and he largely acts as a ambassador in America trying to sell the product. Again, founder-led businesses and conflicts of interest. His wife was a non-exec director. The shareholders at the last AGM weren't thrilled with that, and that's shown in the voting results. So, but rather than fight it, to their credit, his wife will now not be seeking re-election as a non-exec director, and they've brought in a new chief exec who's come in from McKinsey. And at the last results presentation, the chief exec he sounded like he has a good handle on the business and has a good background. So he's worked in this space before and has led digital transformation. And he only ended up at McKinsey because they acquired a similar business to Mind Gym that he'd been a chief exec at for a number of years. So I've now got a chief exec who's got, I think, more appropriate experience and also knows the sector, has the right context. And it was harrowing, but he presented a slide on some of the weaknesses, and he said it's not clear for buyers to understand what they do, so it's very hard for their salespeople to sell it. He said that the business is entirely reliant on salespeople to sell. They've got very limited digital marketing, which he thinks they need to improve. And of course, I think in the long run, that would be cheaper than relying on a network of salespeople. And he also said it's a complex commercial organization and needs tighter commercial control. So that suggests that he's got a handle on some of the wasted expenditure of the past few years. He also said that clients are happy, very happy with the individual solutions, and I think they retain 88% of clients, but there was a complete failure to build on that and sell them other Mind Gym products. So he's already reduced costs and got the costs under control quite significantly. I think there's a general, perhaps, change in the business environment. I think we've seen across the board that businesses are generally reporting better results. So I'm now at the point where, it's such a small holding, and I think I missed the right time to get out, that I'm willing to give this new chief exec the benefit of the doubt and see if he starts to address it. If he doesn't, then whatever scrap I've got left, I'll sell. But it probably means I'm stuck with this and stuck looking at that significant loss for the next couple of years to see if he will execute or not. But, for every system one, there's a Mind Gym, and you just got to hope your system ones add more value than Mind Gyms distract from. And again, position sizing is really helpful. I think any investors who are just starting out, particularly investing in small caps, but I think any investment, I see some people on Twitter or X, which I still don't like, saying that will say they've got all the portfolio in 4 or 5 small cap businesses, and to me that's utter madness, because things like this can happen. So yeah, I've learned a lot. It's been a hard way of learning, but there has been some change in the business, quite significant change, and that is the only reason why I'm still hanging on.
I suppose a good thing is when you talk about, hoping you have more system ones than Mind Gyms, is although you are down 77% on Mind Gym, you're up 165% or whatever it is on System One. And the good news with Mind Gym is you can't lose more than 100%. So as long as that System One figure stays above 100%, I guess you're still up overall if you think of it like that.
That's it. And that's going back to my investment philosophy, that's why I have my strategy on position sizing and trying to hold my positions for a long term. Because I think if I'd have snatched at a system one profit at 50% and then I have this doing this, then my performance figures would look a lot worse.
Can we talk about SDI groups? It's a new investment. So you can tell us what it is, because I've never heard of it, and also why you like it, please.
Yes, so I think on the first interview I did on the Investor Way, I talked about how I categorize my investments. So one is looking at what I think are quality businesses that I can buy for a reasonable price. And another one is looking at businesses that I think have been fundamentally, the businesses are fine, but they've been overpunished by market sentiment. Sometimes the two can cross over, but I think this is very much in the latter category. So SDI, it specializes in acquiring and operating very niche manufacturing businesses in kind of the science, industrial, scientific equipment, in instruments sectors. The business segments are split into two. So there's the digital imaging segment, which contributes, I think, last set of results about 30% of revenues. So that's looking at things like high performance cameras, which might be used in life sciences, astronomy. They had a product called Attic Cameras in this sector, which was used in the COVID PCR machines, and they benefited a lot from one-time orders for those cameras in those machines. So those orders are dropping off, and a bit more on that later, but it shows that there's some good products there. The other segment, which was responsible for 70% of revenue, is the sensors and controls. So again, it's looking at things like chemical sensors, chemical dosing systems, chilling and cooling, heat exchange, lab cabinets, that type of product. So they're very much an acquisition company. What they try to do is target primarily UK businesses with established reputations, where either from a founder retiring or looking for an exit, they're looking to sell. What they want to do is buy those businesses for a reasonable price, looking typically at ones that are generating up to 1 million EBIT and paying no more than around 4 to 6 times EBIT. And they want those businesses to be capable of achieving significant organic growth through, integrating them with the rest of the SDI group and using that network to try and sell those products. And they also take a decentralized approach. So, they try and get businesses with good management and give them generally the room to get on with running the business. And I suppose that moving on to why I like it, I think those products tend to be niche and a bit boring, but they're absolutely needed. So I'm hoping it can be one of those unexciting sectors that continues to compound. And also their acquisition strategy is focusing on smaller companies than private equity would be interested in. Or there's a listed company called Judges Scientific, which is much higher market cap, and businesses like that wouldn't move the needle for either Judges or private equity. The revenues are also quite diversified, so 60% from UK, but the rest is coming from America, Europe, and China. And really, to a certain extent, I think there's been some errors by the company in that I think they've overpaid for some recent acquisitions, and they had a £3.5 million goodwill write down to reflect that. But they also had profit warnings due to that Attic camera for the COVID PCR machines order ending. And they'd also had a lot of their customers destocking following ramping up the orders from COVID and lower orders from China. So as a result, the share price now is at around 67 pence. It was at just over £2 in 2022. And it seemed to me that it was a business that has lacked some discipline in their ability to accurately forecast. And that's been punished, but it's not unusual. Another business I like that we're going to talk about later, Supreme, had a similar thing with destocking. They've got a new CEO who will hopefully introduce some discipline and has got previous experience in this type of market. So they previously worked at AB Dynamics, which is another listed organization which is in a similar sector. And, he's talking about how he wants to acquire those private companies at a significant discount to those in the quoted market. So it's refreshing to him hearing talking about that valuation discipline again. They primarily use debt and their own cash to fund acquisitions. They haven't done an equity placing since 2019. So again, interest rates starting to lower could help that acquisition flywheel, and the debt appears to be well managed. So their interest cover and fixed charge cover are both above the minimum levels I look for. Historically, this has been a good strategy for them. So they grew revenues from 14.5 million and profit from 1.6 million in 2018 to revenues just over 65 million now and profits just under 4 million. If they can keep up that growth, and the current market cap of 70 million pounds suggests that they can, I think there's a chance that the shares will do well. Interestingly, Judges Scientific, which is very highly rated by a lot of investors, has had the same issue with China. Their shares are a lot highly valued and were punished. SDI's on a PE of 11 based on our SharePad data. Judges is just over 29. Now, Judges may well be a far better business, but again, is it that much better than SDI? And going back to that Alta Fox capital study, one of their key findings was that just over 50% of those multi-baggers made regular acquisitions to aid growth. So again, this is in line with that study. It's another one where I think it's had a setback. Hopefully the management tweaks, the chair's long-standing, so you've got some continuity there. But hopefully those management tweaks, I think they said at the last presentation that they were going to be more realistic and robust in their forecasting. Hopefully that will prove to play out in coming years. So it's an interesting business, and the products are quite interesting. There's a lot of good detail on the website about different products. And it's one of those where I think the price isn't screamingly cheap, but potentially on a risk reward basis, there could be a decent level of reward here for at least a medium term view.
I think for me, I think a lot of the points you've raised made a lot of sense. However, for me, it's just because the products seem to be so specialized, it's to me, I'd view it like kind of like analyzing a pharmaceutical company, where it's like, well, that might all sound great, but how do I know they can keep developing that next product, if that makes sense? That's what I'd really struggle with as an investor with something like that, because I just don't have the skill set to sort of analyze it. And you just have to have so much trust in management to be able to, for me, to be able to sort of sit back and relax.
I think that's a very fair point, Sam. It's something that I wrestled with, alongside that, in this space, products can become obsolete, are they reliant on acquisitions to cover for their older acquisitions becoming obsolete? Who knows? So it is a difficult one. I think this is one where I've got a half position size and I'm probably not comfortable on going beyond that for exactly that reason.
So you've got two investments that are marked as buckets that play on improving investor sentiment. So can you discuss those and sort of what the logic is behind them?
So those are asset managers. So towards the autumn of 2023, there was a lot of asset managers showing up on one of my SharePad screens, and they had very depressed valuations. And as a sector, I was interested in it because they tend to be very high margin, cash generative businesses. I was looking at it and thinking, I can't say if it's the bottom of the cycle for the asset managers, but I think it's certainly one of the worst points in the cycle we've had for some time, given the general bear market we've had across the investing universe at that point. And that's compounded by how unfashionable the British stock market was. So my thesis beyond this on this one is that essentially as the market takes a turn upwards, interest rates are starting to drop, which means lower saving rates on things like savings and T-bills. And you'll get a flood of money returning back to the market. And I think there's nothing like a rising market for more money to flood back into it. And essentially, the asset managers will be a beneficiary from this because more assets under management mean more revenues and profits, and they tend to largely pay that out as dividends. So I chose two companies as to put in my bucket to play on that theme: Impacts and Lion Trust. The reason I chose them over other listed asset managers in the UK is that both serve public and professional investors, so they've got both areas of the market covered. They both have a tilt towards ESG, which, I look back to how overdone that as a theme was, and there's almost been a equal backlash against it, where it's almost viewed now as a bad thing. And I think in reality, that as a theme will probably go back to somewhere in the middle of those extremes. So I think people think it should hold more importance than some of the backlash now, but perhaps not be important as what it used to be. Impacts is the one that I view as better quality. It also runs private equity strategies, so it's got that another element of the market there, and it's expanded its fixed income offering through acquisitions at a time when the market has been cheap for those acquisitions, and it's founder run, and the founders still own 7% of it. My theory on this one is to hold it through the cycle. Yields are high now, so I'm getting paid a nice dividend, and I think that I will potentially look to sell at some point once once the cycle upturns and we start to get back towards historically what has been viewed as the high point in the cycle. I do think there's also the potential for some consolidation in this space, given how depressed the valuations are on those. I think in terms of the drawback, the things I've been considering, I think one of the reasonable views would be that won't people just go for passive, and doesn't that have a negative impact on the performance of these businesses? Yes, but I think the passive trend has been in play for long enough now, and I think to a certain extent there'll always be a room for some active exposure. And who knows long term what will happen if we ever get indexes in a sustained downturn. We might see active start to come back in more fashion if it becomes a stock pickers market. So yeah, that's my play on hopefully some improving investor sentiments in the next few years.
You're still holding Supreme as an investment, so I'm not sure I can't remember now what your cost basis was, but that's one that I think you were holding last time you came on the show. Me and John then ignored you for about 12, 18 months and then bought it after that. So why do you still hold it and why do you still like Supreme?
I think yours and John's timing was impeccable on that because
It was luck, but yeah.
it's yeah, better to be lucky than to be good, as the saying goes. But I still hold it. I think I'm up around just over 30% on Supreme. The reason I still hold it is essentially the management team of executors. They've done exactly what they said they were going to do, and I think that the chief exec has continued to be a shrewd operator, and he displays the kind of business acumen that you want to see in a chief exec. And for the listeners' benefit, I think one example of this is that in August 2022, Supreme bought a vaping company called Cuts Ice out of administration for 2.6 million. Cuts Ice had a brand called Tea Juice, which was more popular in the European market, and that tea juice brand had been valued at 1.4 million in that deal. You go forwards not very far to March 23, and Supreme sold the intellectual property of tea juice to a big French vaping company for 4.5 million euros. And then alongside that, Supreme came to an agreement with that company to retain the exclusive manufacturing rights to tea juice with a minimum of £15 million of revenue over 5 years for Supreme. And I just think to do an acquisition like that and realise such a return in such a short space of time. I mean, I don't think you get the opportunity to do those kinds of deals very often, but the chief exec of Supreme talks a lot about that acquisition discipline and wanting to buy things that are absolute bargains. And, it's very rare to get a chief exec who actually can follow up on those words. And I think that ethos is still shown in the underlying business. So return on capital employed is consistently 25% or higher, which just shows how efficiently the company's making use of its assets. And also the Elf Bar distribution deal has contributed significantly to recent business performance. Now that has given me pause for thought, because clearly when the disposable vaping ban comes in early 2025, those revenues and profits are going to disappear, along with those from Supreme's own vaping brand. And I have been weighing up whether there's a sweet spot to exit this as an investment before the impact of that disposable vaping ban has been felt. The one thing I suppose that gives me a little bit of room to think about and perhaps hold on is that, one, the valuation is still incredibly cheap, and the chief exec has claimed that the disposable vaping ban will be positive for reusable vapes and their flagship 88 vape product. And he thinks that he said that the refillable ones are actually more profitable for Supreme. And I do think there's something in that. I think, humans for centuries have used nicotine, have used alcohol, and they've gambled. And I think, regardless of people's ethics and thoughts, I don't think you can say that suddenly, disposable vaping ban, people moving away from smoking, humans are just going to stop using nicotine. That's quite a stretch. And certainly I can't see it happening, say, in the next 2 decades. So I think he might have a point there. Whether the younger generation will move on to refillable vapes or just give up if they can't get hold of a disposable one on a night out, I'm not too sure. I was quite a grumpy old man before my time, so I was never the right person to opine on youth trends, and certainly aren't at my current age. And also, I think the other thing to remember is Supreme are more than just vapes. So they bought Clearly Drinks for 15 million in June, which has revenues of 22 million, and I think EBITDA was 3 million. And part of the attraction of that deal was that we're getting a new state-of-the-art manufacturing facility that Clearly Drinks had just invested in. So that again suggests they can continue to get a lot of value from the assets as part of that deal, and they're going to use their existing customer relationships to cross-sell those products. So if it can continue to generate cash and use this for attractive acquisitions, including diversifying beyond vaping, which it already has with its, lights light bulbs, batteries, sports nutrition and wellness divisions, then I think there could be more growth to come still. Say, I think the PE on SharePad's around 10, so that's still attractively priced, particularly when you consider similar types of business. If you take away the vaping elements, it pays a dividends. The chief exec owns more than 50%, and he has added when the share price was depressed, and also he'd sanctioned buybacks. So yeah, for me, you've got here a chief exec whose interests are very, very clearly aligned with shareholders. We're all told how important that is in a business. So okay, concerns about vaping, but would you want to bet against this business and this chief executive based on how they've performed to date?
I agree. I think those concerns about the vaping are fair because I think if we compare the business now to when you first came on the show 2.5 years ago, it is much more of a vaping story just because of how phenomenally well that side of the business has done. But like you say, they are reinvesting in other segments of the business as well. When you watch like the investor presentations and stuff, I think the CEO, I do like the way he comes across. I think he comes across very well, and I think he does come across as sort of very trustworthy. But he also slightly comes across as the kind of guy that will always see the positive side in everything that's happening with the business. And I feel like when he says over 50% of people will move over, I don't know whether that's the case or not, and I hope it is true. I think if you to look at sort of 17, 18-year-olds, if they can get the rechargeable ones and they've still got all the flavors, it's like, I mean, it's not great from a societal point of view, but you just need one in a friendship group to get hold of one on like a debit card or something like that, because you can get them posted to you. You just need one to get hold of one and start passing it around, and before you know it, people are still doing it. I think the fact that you can't get a disposable, how much of a difference will it really make? For example, like part of the reason they're getting rid of the disposables is because like there was concerns that too many were being sold to children, but it's meant to be an 18 plus product anyway. So I have quite serious concerns with that. That the people who if the kid's determined enough to get one, they're just going to get an illegal one like they had previously been doing anyway. I think it's very, very difficult to say what impact the ban will have, and then there could well be quite a few unintended consequences of it. But I think the thesis that more people will move to sort of the higher margin rechargeables is not an utterly ridiculous one. I think my main concern will be, well, what does that do to Elf? Because when you think of Elf, they're basically exclusively disposable, as far as I'm aware. Now, it might be that you can take that Elf brand and do rechargeable stuff with it, and that's still worth quite a lot. But I suppose if they're just doing the distributing and manufacturing, it's less risk for them anyway, albeit some of the EBITDA might disappear.
I think I've always viewed that with the main risk of Elf because they're purely distributing. It's obviously because of the popularity of that brand. It's been very profitable for Supreme. And the question always is that, okay, there might not be much of an impact to their operations because they are just a distributor. But if you lose that level of pure profit, then I find it hard to believe, even if the markets should know that, I find it hard to believe that they wouldn't be punished for that when you start to see that drop off their results. Have you come to a decision on whether you're going to hold or sell Supreme, Sam?
I don't think I'll sell before the ban. I think I'll probably sort of give it a set of results. It's hard because it's like you say, it's so cheap, and I do like the way the business operates. And I do think long term, I think there's something to be said as a very, if you think much longer term, to have a vaping business with that kind of market share in the UK that doesn't have that legacy of the tobacco business staining it, I think that's quite attractive as well. Especially, we see it when we cover the tobacco companies, the volume sales are now starting to decelerate, starting to drop off much more quickly now. Where they were dropping volumes 2 or 3% a year, you're now looking at sort of 6 or 7. And I think a lot of those, I mean, some of it will be people that are dying and sort of new kids are coming in and just never smoking in the first place. But I think there will be more and more of them that are switching to the non-combustible products. So I think as a long-term play, I still think it's very attractive. It's difficult because I think in the time we've owned it, obviously we've done very well with it, and it's basically doubled, in like a year, 18 months for us. But the multiple hasn't changed. That's just because the earnings have gone up. It's basically stayed at a 9 or 10 PE the entire time we've owned it. So yeah, I think for me, I'll probably give it 6 to 12 months. Maybe that'll be a mistake, but I think after the ban, I'll give it 6 to 12 months because I would hope that it would weather the storm quite well. I know it's a completely different type of business, but we cover Coca-Cola Hellenic Bottling Company on the show, and that's one where it's like Coca-Cola, but in like emerging markets, and two fairly significant markets, not huge because it was in like 25, 27 countries, but like, the share price dropped by like 20, 25% the day Russia invaded Ukraine, because those were two of the markets they were in, and those markets were just obliterated. And then you give it a couple of years and it's sort of back above those pre-Ukraine levels. and it's basically fully recovered that. I think when the business is good enough, like Money Supermarket, that's another one. Obviously, the energy switching business just dropped off overnight, and that's still not come back. And they've made some smart acquisitions, and that business is basically where it was pre the energy switching market getting turned off. I think when you get a business like that, where it's like you trust the management and you like the management, and they're making these smart acquisitions, I think even if you've got something like the disposables ban, it's probably worth sticking with it long term. But yeah, in the short to medium term, you might have a little bit of pain. So I think that's probably the view I'm going to take on it.
Yeah, I think that sounds sensible. I suspect I'll probably end up doing something similar to that myself. And to a certain extent, I do think the low valuation offers you some protection. So it was interesting that on the day that the government announced the ban on disposable vapes, Supreme share price actually rallied. And I think clearly the market was expecting the government announcements to be more draconian. And I do, it feels quite binary, doesn't it, really, the reaction that, if the disposable vape ban doesn't really have as big an impact as is feared, could you actually see results worsen for Supreme? But the share price rise because the impact's not as bad as fears. It's difficult. If any other listeners have got a good strategy to try and play that, then I'll be very interested to hear.
Yeah, me too. So please do get in touch. So you've got Volution as well as a new investment. Can you tell us what that is and why you like it?
Yes, Volution is one that I'd had on my watch list for a little while, and it came into a valuation range where I was happy to take a position. It offers ventilation solutions to residential and commercial customers. So things like heat recovery units, extractors, and it has a focus on minimizing energy use. It's diversified across the UK, Europe, and New Zealand. One of the things that I like is its exposure to those favourable themes. So building standards across the world are only increasing, particularly with issues such as, need to keep homes warm, problems with things like mold and damp, and increased standards around air quality as well, with the impact that can have on health, and also the need to make homes more energy efficient. I think that the new Labour government's aim of 1.5 million new homes should boost this part of the Volution business, but also the older housing stock need these products to deal with that changing climate. It has good quality metrics, so its operating margin is above 20%, and the return on invested capital is also above 20%, which is greater than their cost of capital, which is the main hurdle you want them to overcome. Chief exec, he's been there since 2008, clearly knows the business very well, comes across as a bit of a ducker and diver at times when you listen to him, but he's got significant skin in the game in that he holds 1.5% of the company. They do have some organic growth, but typically they do use acquisitions to improve that growth. And it's similar to SDI, I suppose, in that they look at businesses that can buy at an attractive price, improve the margins of the acquired business, and they also use it to cross-sell products, because if someone needs some extraction, they might also want some energy recovery as a part of that, or heat recovery. Revenues and profits have grown steadily, and they also paid dividends in addition to using the cash generated to fund acquisitions. Again, it's quite a fragmented market, so there is opportunity for further growth. Market cap's now around 1 billion, so there's room to grow further. And I just think it's in an area, in a space where there'll only ever be more demand on those type of products. The other thing I like is that for once, I looked at an annual report and found some management incentives that I thought were more aligned with shareholders. So their current LTIP specifies a total shareholder return of 20% as a hurdle, and they say they've got a desire to include a return on invested capital measure in the next LTIP in 2025. But it's just so refreshing not to have a simple EPS target, which management can quite easily game. So again, I'm hoping it has the hallmarks of a decent quality business, and I'm hoping that this can just quietly compound in the background for me, and whilst also being exposed to some favourable growth trends, although ideally wouldn't want to be exposed to climate change at all, but that's not the reality of the world we live in.
I don't think it's one we've ever looked at before, although it is FTSE 250 listed, so we will have seen it has been reporting earnings and then chosen not to cover it. So I'll have to cover it next time we look, next time it's reporting some earnings. But what do you think about the PE then? Because that's 20, so that's, I suppose it's fairly high. I know that when you then go and look at, so I always just go straight to the last 5 years financials, and when you look at that, obviously revenue is up about 50%, operating profits more than doubled, and that's flown through to earnings per share. So I guess on that basis, if it can do that in 5 more years, 20 times earnings is probably pretty reasonable.
I think I bought it at the top end of my valuation range that I was prepared to buy it at. It's up over just over 20% for me. Again, at this valuation, I'm happy to hold, particularly in light of that potential growth that you've pointed out. I'm not really looking to add at this valuation range. It's one of those where I'll just keep an eye on it, and if there's any share price weakness which brings it back into range with for no reason, the underlying business performance isn't a factor, then I may look to add a little bit, although I've got a decent position size at the minute. But yes, I think the valuation at the minute's a little bit peaky.
So that's the end of my questions. I think you had some comments of your own you wanted to include on ISAs.
Yeah, I think people will have to forgive me and indulge somewhat a bit of a whinge about ISAs and tax policy, but I was listening to the This Is Money podcast that Robert Peston and Steph McGovern host, which is it's no investor, but it has some interesting guests on there. And they had a guy called Torsten Bell on there who was the chair. I think was a director at the Resolution Foundation and now is Labour MP. And he was saying that essentially he was saying that anyone with 100k in an ISA is rich and they shouldn't get the tax benefits of that, and effectively you should almost cap the tax-free bit of the ISA at 100k. And I just thought, that talk about what I think is a bit of an uninformed viewpoint. So, I think if Torsten Bell's looking at financial security and wanting to, improve people's long-term financial situation, you should want more people to invest as it builds wealth. I was quite ignorant about the stock market as I grew up, and I think if he educated people about the power of compounding and investing, and I saw how much better that is than saving, then that could only benefit society. And I think generally people from lower income families have much less knowledge of investing as a wealth generator. It just seems something that's ununderstandable to people. And I also think there's a danger of unintended consequences there. Now, clearly, I think a lot of us would probably aspire to have 100k in our ISA at some point, and certainly if you want some form of financial independence using your ISA, you're going to have more than that. But nobody enjoys being taxed, and that would effectively be, certainly for myself, double tax. So, I take my post-salary income, put that into my ISA, paying tax again on that doesn't seem very fair. And I think, again, we talk about the UK investing market and the UK stock market and the need to increase participation. I know from a lot of private investors through Signet that I'm a member of, a lot of us do have shares in smaller British companies because institutions aren't necessarily interested in those companies. They're too small for them, and Britain isn't a large market, so you're not going to have a lot of your British exposure in those type of companies. Having to pay tax again on that, it makes that acceptable investment return so much harder to achieve. So I just think it could have a very negative impact on the British stock market, as well as people's desires to become more financially secure. Because why would you be double taxed in investments in an ISA when, for example, you could probably overpay your mortgage and get a better return from that in light of higher mortgage rates? So I just think it's a bit of a shame that is being put out there, and perhaps if listeners feel the same, I could contact their MPs and express their displeasure. But again, I look at someone like myself now. I don't think anyone would call my background rich. I'm not going to inherit anything from my family. They don't have the assets. That's, again, that's fine. That's life. That's why I'm trying to secure my own future. I look at someone like Torsten Bell, who, his parents one was a policy analyst, one was an academic. He went to Oxford. His brother went to Cambridge and is a civil servant. Torsten Bell's now an MP. I dare say that it's a reasonable assumption that his family estate is worth more than 100k. Is he going around saying that anyone who stands to inherit an estate of more than 100k is rich and should be taxed more on that? I don't think he would. So I think this targeting ISAs and people who are trying to save for the future. I just think it's the wrong thing to do. We should be encouraging more people to do that, and particularly more people from lower income backgrounds than actively trying to discourage them. So that's my bit of a rant about tax policy. Over and done with. I won't stray into those areas again because it's not my background. But yeah, I think it's a bit disappointing hearing things like that. We should be trying to encourage more saving and investing, not punishing people who do it.
Yeah, I mean, I guess that is just one Labour MP, though. It's not a policy decision, is it? I think we have to see what happens in this October statement that we're all looking forward to. But I think in terms of because obviously I work in tax, in terms of I work in personal tax advisory, so it's just pure speculation, and you never know really what's going to be in a budget. But the stuff in sort of industry publications in terms of what people are expecting pension relief to come under fire, which isn't that surprising because when the Conservatives increased the pension relief a couple of years ago, or whenever it was, a year or two ago, Labour basically came out straight away and said they were going to reverse that. And then the other one is capital gains tax, where there's talks about bringing the capital gains tax rates in line with income tax, which again, unless you've got the problem that you're maxing out your ISA every year, you're not going to be affected by that. So, but I've not really seen anything in industry publications that suggests people are expecting that. And I think with stuff like that, I know at any point the government can come in and do something more radical, but what they tend to do, because it's easier and people don't notice it as much and you get away with it, is just freezing the bands. So it's like obviously I know that again the Conservatives increased the ISA limit to 25k because you've got the new 5k British ISA, which at some point they may just scrap that. That wouldn't be surprising. But in terms of the 20k limit, it's been the same for like 20 years now. And sort of the easiest way to sort of erode it is actually just to leave it where it is. And it's nowhere near as controversial as just scrapping it. But, over the long term, the effect is basically the same. So I think that's probably what we're more likely to see. But I think it would be a shame. But I think as well, all it would do, it would just sort of alter people's behavior. Like, because again, it's like that, the limit for pension contributions is so high that most people will just never hit it. I know the ICE is instantly accessible, but I think it will just change behavior and that you might have a lot more people where actually they start putting more money in a pension because then they can invest that however they want tax free. If you have a SIP on Hargreaves Lansdown, you can buy pretty much all the same shares. I think it's easy to have some kind of like survey or something that says, well, if we'd done this, we would have raised this much additional tax last year. It's like, well, yeah, but you're assuming that everyone's behavior is exactly the same, which it won't be. So, there will be a natural consequence that what will happen is people will get up to 100k in an ISA and they will stop saving and they will go into some other vehicle instead. So, yeah, hopefully it doesn't happen, but I don't even know if it did, it would have sort of the tax effect that people want because I think people would just change their behavior.
No, I think you're right. I think that's the thing with looking at where you can get tax from. People assume that the introduction of the new tax policy doesn't change people's behaviour, like I said, when in effect it does. So no, I hope that. I think it's you never want to hear politicians saying things like that. I think he looks at it the wrong way. He should want more people to be using their ISA for investments really and creating wealth. So hopefully it's storm and teacup, although it has gained a bit of traction in publications like the Investors Chronicle, but I suppose it always would do in those publications.
Well, yeah, and it gives, people are going to read it as the thing. If you subscribe to the Investors Chronicle and you see an article about that, it's going to get your blood boiling. And I think that's sort of the idea of it in terms of the journalism aspect. But I just think as well, it's like you've got a wider problem in this country too, where it's like most people's pensions are underfunded. I think pensions are nowhere near as generous typically as they were. If I look at my granddad's pension, he's on like a nice cushy defined benefits pension scheme. And if I was to go and do exactly the same career that he had done, which finished in sort of 2000, I would not be able to get the kind of pension that he was able to get. And outside of the public sector, you never see them now. And I think most people aren't saving enough. They might do the minimum 5% and the employer adds 3, but when you look at the amount they're actually left with to last the rest of their life, for a lot of people, it's not a huge amount of money, and I think a lot of people just don't think about it. But the government is probably very aware. And then again, when they reformed the state pension in 2016, when they brought in the new state pension, that again typically far less, well, it is just far less generous than the old system had the potential to be. So most people can't be relying on the state pension. And if anything, it's probably going to get worse before we get there, because they'll probably raise the age for it again, or decrease it further or something like that. Or even just, increase the number of qualifying years that you need to qualify for a full one. So I guess for a Labour government or whoever it is, that does it, it maybe doesn't matter because you only need to think about the next 4 or 5 years. But in the longer term, there is a problem building in this country where people are not saving enough for pensions, because the pension schemes that they used to have in sort of the 60s, 70s, 80s were just too generous and they can't afford it. But it's like if you'd gone to work sort of 30, 40 years ago, you didn't really need to worry about sort of saving for your pension, because the pension scheme that you were in automatically, in a lot of cases, just would have been incredibly generous.
Yes, I agree. And there's talk about, like you say, I suspect pension ages are going to get higher, and there's talk about means testing for pensions. So really, the more people can do to support themselves, the better. I would add that that's not based on, my viewpoint there is not based on politics. It's purely on tax treatment. I'm politically neutral. I dislike all politicians equally. Before I get any of the ex-political warriors on my back, I dislike all politicians. So please don't tweet me with political stuff.
I mean, there's some stuff where they will just do it because it's more political point scoring rather than because it's sort of sensible policy. Because again, the problem is if you go and do introduce that, I mean, the average person reading it will say, "Oh, well, it's only over 100K. We'll never have that much in an ISA or whatever else." Like it's almost like as long as the majority of people reading it think, "Well, that won't affect me," people tend to sort of think it's okay. If you can be a fairly normal person, you can save a few grand a year or whatever in an ISA, and if it performs well as well, whether it be 100 grand on a cost basis or a value basis, I don't know what the plan would be. I suspect that MP doesn't either. But if you're disciplined with it over a long enough time horizon, like most people can get to that 100K, people will start hitting it. So it's not a completely inconceivable figure, even for someone that's on a fairly low salary. So yeah, I think they just need to be very, very careful with stuff like that. Even if they were to do it, obviously what would happen in 5 or 10 years under another government, you don't know. So I think all you can do is plan for the rules you've got.
Yeah, I agree. I agree. It's yeah. I mean, political goalpost shifting. It always happens. You're not going to do it, but I think that's the missed opportunity for me. If people saw what just putting a little bit of money in a tracker fund in an ISA and having it compound at say the historical average of 7% a year, like you say, it sounds like a big number, but I think people would be surprised at what they could get to with a relatively small amount as long as they do it early enough and often enough.
I think a lot of it as well, it's like if you go back to the example of workplace pensions, most people, the default will be that they're in a workplace pension scheme. 5% of their salary is taken at source. The employer adds another 3%. Most people just kind of think it's in the pension and they don't think any further. And like, if you were to go into, for example, I obviously I work in a firm of accountants and there's maybe like 30, 40 people in my firm. The number of people that will have actually set up an online account for their pension scheme to log in and choose what it's invested in, or even look at what it's invested in. I'd be surprised if it's even 25%. And that's in a firm where, the people are financially pretty intelligent, which is quite concerning, I guess. But like, even in a sort of, you go in an office full of accountants and people will be like, oh, I don't want to know. They don't want to look at it. They don't want to worry about it. And then the problem is if you come in at sort of 20 years old when you're starting working and you do that, if you were to actually log in and look at what it's invested in, it will put you in sort of the low risk thing as a default. I think there's a very strong argument that if you do like a little bit of research about it, you don't have to do loads, but if you read a couple of books on investing or something, you'll pretty soon realize, well, actually, I'm in my 20s. I've got maybe 40 years or even 50 years ahead of me of investing, depending on when I want to retire. Whatever happens in the stock market, I can ride out the next few cycles with absolute ease. And when you sort of look at it like that, it's like, as well, I'm not going to be able to access this for 40 years, so I'm never going to need the cash. And my conclusion is, well, actually, if you're in your 20s or 30s, I think there's a very strong argument. Your allocation to equity should be 100%. And if you're in the default pension plan, it won't be. And there'll be cash and bonds and gold and whatever else that's mixed in there. The idea is to lower your risk, but actually all it's actually doing is lowering your volatility, which in your 20s and 30s and probably 40s as well, you just don't really need, because you've got so much time ahead of you to ride out any cycles. But again, it's that's not even like a tax policy. That's just sort of educating people just so that they can get to a level where they actually think, well, actually, I do need to log in and actually have a look at this. And maybe actually, even if I'm just checking in once a year, it's a fairly basic thing that most people should be doing, but unfortunately they just don't.
I agree. And I think, that to me makes it even worse that risk is actually volatility, because volatility matters less if you've got people who aren't engaged with the process and don't log in very often, if
Yeah.
at all. It can be as volatile as it wants, can't it? As long as it
But it's like
broadly
Buffett
goes up
says,
and to the
they
right.
like volatility because they can measure it.
Yeah. Yes, very true.
Right. So I think that's everything in that case. So if people have enjoyed listening to you, or even if they haven't, where can they find you if they want to learn a bit more about you or follow you on social media?
So I'm on X, although I still call it Twitter. My handle is at Paul Ahdal. So my surname is Ahdal. I also have a blog where I sometimes write up my thoughts on investments, but haven't done it for a long time, although I'm going to try and get back into that discipline, is Mr. Misanthrope blog. I think Sam will probably include a link in the show notes. And generally, I think X has definitely got less enjoyable, I think, post Mr. Musk's takeover, but I'm primarily on there for the football chat and the investing chat. So always happy to engage with any people with sensible thoughts on investing.
Right. Well, thank you very much for coming back on the show. I think that's everything in that case.
Thanks, Sam. Good to talk. Been a pleasure.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.